Hello, everyone. I'm Allison Christians. I'm the Stikeman Chair at McGill University, and we're really pleased to introduce Wura to some of you. Some of you know her. So I'm just thrilled that you were willing to join us for the colloquium.
Thank you. Thank you so much. I'm very privileged to be here tonight to share my paper with everyone. And this is something that is very significant, and I hope everyone would be able to share their thoughts and, at the end of the presentation. Okay, so I'll be talking about my paper, Fostering Effective Tax Systems, Reshaping Bilateral Tax Treaties to Generate Revenue for Sustainable Development Goals Implementation in Africa. So basically what I'll be talking about is the problems with the tax treaties that African countries have signed. And I use Nigeria as a case study and how these treaties can be reshaped to generate revenue for sustainable development goals implementation in the continent. So my introduction, African countries are behind in social and economic development. And the citizens of these countries experience high levels of poverty and hunger, unemployment, maternal and infant mortality, lack of access to quality education, gender inequality, and other social, economic, and environmental ills. So as someone who grew up in Nigeria, these are issues that I witnessed on a daily basis. It's around me, and they are real issues. And one thing to say about these issues is the fact that the nature of the challenges are multidimensional in nature. And so when we talk about development challenges that African countries face, it's not just limited to the problem of low income, which is often cited as a threshold for determining development. So they include like lack of basic infrastructure, such as safe drinking water, health services, sanitation, education. These are basic amenities that citizens of developed countries have access to, but unfortunately are absent in developing countries and African countries specifically. And so to fix these challenges, African countries have been encouraged to improve on domestic resource mobilization. And so emphasis is particularly placed on taxation as a primary source of funding for development project or funding development project, because it ensures ownership as against reliance on aids and grants. So I'm being careful. I'm not talking about African countries as monoliths. I know that African countries are different. I mean, there are many countries that make up Africa, but a lot of these countries have a lot in common in terms of large populations that lack access to basic amenities and weak institutions committed to redistributive functions for the benefit of the poor. So these are challenges that are common to most of all the African countries. And I don't know if you are aware, there was a protest that happened about a month ago in Nigeria, where the youth took to the streets to protest the right to basically to leave, because the police were shooting people and just, doing all sorts of illegality in the country. And there were a lot of youths that took to the street to protest, not just against police brutality, but also against lack of access to all these basic amenities. I just thought to add that. So domestic resource mobilization is regarded as a more viable and sustainable way of actualizing the UN Sustainable Development Goals. And so there's this responsibility that is being placed on African countries to consider some of the factors that limit the revenue potential of tax in African countries. And so I would just be talking about international factors, the factors in the tax treaties that African countries have signed. And I'll be arguing that these gaps actually restrict source taxing rights. And if they could be expanded, then African countries would have more money to implement development projects. So the focus of this paper is a presentation of homegrown solutions to the structural barriers in tax treaties that limit domestic resource mobilization. And so, like I mentioned, I discussed source restricting provisions in the tax treaty of African countries, and I use Nigeria as a case study. And I also discussed the OECD's dominance in establishing international tax rules and the implications for African countries. So I conclude by recommending a cost-benefit analysis of the tax treaties signed by the African countries. So rather than just assuming that everything is fine, I would urge and I recommend that African countries should consider, analyzing some of the tax treaties that they've signed, some as far back as 1970s, to see how these provisions actually reduce their taxing rates. So let me talk briefly about the Sustainable Development Agenda. So the Sustainable Development Agenda, I would refer to it as SDG agenda in my discussion, is an action plan, a sort of consensus by world leaders in 2015 to jointly tackle poverty in its most extreme form in all the nations of the world. Countries came together in 2015 and they reached a consensus, and they kind of developed a roadmap covering several development challenges. They include poverty, health and well-being, gender equality, core issues of economic growth, pervasive concerns of global warming, social justice, and peaceful and inclusive societies. But one thing they noted was that these development challenges are actually most prevalent in African countries, least developed countries, landlocked developing countries, and small island developing countries. So there is emphasis on the challenges being most prevalent in African countries. Another thing I would like to talk about is the fact that under the SDG agenda, there is a consensus that development means human development, so not just economic development, so touching on all aspects of individuals' well-being. And this was actually referred to in 1996 by the Human Development Report published by the United Nations. And so they put it this way: human development is the end, economic growth a means. So not just economic growth of a country, but actually how policies and rules affect the day-to-day life of the citizens of these countries. So I have here that the concept of development is actually not new. It's been used over the years. It's been utilized to express ideas of to express ideas on how developing countries can achieve development. We see under the modernization theory, this is a theory that looks at the internal factors. Okay, so I was talking about the modernization theory. So it looks at some internal factors of a country, and there is an assumption that developing countries can be brought to development in the same manner that developed countries are being. So there is a notion that developed countries were once developing countries. They once had all these development challenges. And so if developing countries would follow the path that was followed by developed countries, they too could achieve development. But the dependency theory actually rejects the modernization theory. So proponents of dependency theory argue that developing countries are not merely primitive versions of developed countries, but they have unique features and structures of their own. So if they're allowed to develop based on their own realities, based on their own terms, they would actually eventually achieve development. Yeah, so there is also the use of the term, of the concept development in neoliberalism. Proponents argue that government prevents development through too many rules and regulations and taxes, and so development can be achieved by liberalizing the economy, for example, to eliminate price controls, deregulate capital markets, and lower trade barriers. So there is also the term of development being used in this economic theory. And that was actually one of the concepts that was used in the policies exported to developing countries and African countries, especially in the 1980s by the World Bank and IMF. And so they argued that the best way to achieve development was through neoliberal policies. But we see that this failed. We can see that from the financial crisis of 2008, that actually inequality was promoted both nationally and internationally as a result of these neoliberal policies. So the major thing here is the concept of development that should be promoted in Africa, that's my argument, is one that delves into the systemic issues that impede socio-economic development in a continent. So there are a lot of structural issues that need to be fixed, and so African countries should pay attention to these structural challenges. And also the second thing is that taxation should also be used as a viable tool for socio-economic development. And I guess that's where my paper comes in. So the emphasis on domestic resource mobilization is to emphasize that effective, efficient, and progressive tax systems with appropriate tax policies should be implemented to improve domestic resource mobilization. So there are two key documents that emphasize taxation as an important tool for implementing the SDGs. The first one is the Addis Ababa Agenda on Financing for Development. It highlights concrete roadmap for achieving development, to solve development challenges. And the second one is the Fiscal Policy for Financing Sustainable Development in Africa. So both reports actually highlights resource mobilization as a key tool for generating the revenue needed to fund development in African countries. So we see that there's been emphasis on taxation, taxation as a viable tool for implementing the SDGs, and I also believe that that's true. I just believe that there are structural issues that need to be fixed before tax can work for Africans. So a very brief history of the international tax regime. It was created in the 1920s by developed countries who came together to solve the problem of double taxation, and so it was a concern, and so states came together, developed countries came together to cooperate on international tax matters. And so the structure in the 1920s led to the creation of tax treaties. And after the collapse of the League of Nations in 1946, the OEEC, that's now the OECD, took over the responsibility to coordinate the national systems of business taxation of its member countries. And so what we would see is that the OECD model actually has very strong bias for residence taxation. And we know that in the context of developed and developing countries are source countries because they are majorly capital importing countries, while developed countries are the residence countries. So the OECD model is biased towards developed countries. So let me just talk briefly about the emergence of tax treaties in African countries. So after colonialism, tax treaties were accepted by several African countries, and then they concluded new tax treaties, majorly based on the OECD model. So that's a very, very big gap there. So a study by Martin Hairston using archival documents relating to UK policy in tax treaty negotiations with developing countries show that tax experts from the UK actually dictated the terms of the treaties by insisting on source restricting provisions. So this is a challenge. You know, when two countries come together, one developed, another developing come together to the table to negotiate a tax treaty, there is insistence by developed countries on the provisions of the OECD model. And the implication of that is that it restricts the taxing rights of developing countries. And so African countries actually accepted these source restricting provisions in the hope of attracting foreign investment. So the argument is that when you agree to these source restricting provisions, then you will be able to attract foreign direct investment. But research actually shows that tax-sparing provisions in tax treaties and in national laws have had no impact on investment in Africa, but have produced tax revenue losses. So I'll talk briefly about some of the source restricting provisions in the OECD model. So the first one is Article 5. So it prevents source countries from taxing profits derived from source countries other than profits derived through a permanent establishment as defined in the model treaty. So there is the definition of a permanent establishment and any profit that is earned outside of the permanent establishment is not taxable by the source country. So Article 7 is another example. It restricts the scope of items which could be included in the profits of a permanent establishment. As I would later explain in the UN model, the UN model is an alternative to the source restricting provisions in the OECD model. Then other examples are Articles 10, 11, and 12, which prescribe low withholding tax rates for dividends, taxation of dividends, interest, and royalties paid to affiliates by multinational corporation entities in source countries. So the UN model tax convention is an alternative to the OECD model because it contained source expanding provisions than the OECD model. It was developed in 1980 when the UN established the Committee of Experts on International Cooperation in Tax Matters, and their work led to the publication of the first UN Model Tax Convention. It has been amended over the years, but one thing to note is that the experts actually relied on the 1977 OECD Model Tax Convention as their main reference text. So background, the UN sought to create a model that was more sympathetic to the interest of developing countries by balancing the need to encourage investments in these countries with the preservation of source country taxation rights over economic activities in source countries. So the UN model, they recognize the fact that the OECD model favored developed countries more, and they wanted a model that favored developing countries. And so that was why they created an alternative to the OECD model. But there are fundamental problems with the UN model as well. So it's not perfect. So the UN model is reactionary. It does not fundamentally depart from the OECD model. As I noted earlier, they used the 1977 OECD Model Tax Convention as their main reference text while drafting the provisions. So while there are source expanding provisions in the UN model, it's still not enough because it doesn't proceed from a position of compromise, a position of the realities and need of developing countries. Okay, so let me just talk briefly about some source expanding provisions in the UN model. So under Article 5, which is the permanent establishment provision, and what that means is before a company can be taxed in a source country, developing country, African country, then there is a need for some sort of nexus. There has to be that nexus between the entity and the country. And so the threshold is the permanent establishment provision. That's the threshold in tax treaties. But the UN has a broader definition and a smaller time threshold for the establishment of a permanent establishment. So for example, supervisory activities is listed as one of the activities constituting a PE under the UN model. Another example is time threshold for building sites, construction, assembly, or installation projects, or supervisory activities. Under the UN model, it's 6 months. Under the OECD model, it's 12 months. Then provision of services in the source country would constitute a PE in that country under the UN model. This provision is absent from the OECD model. Then the use of facilities solely for the purpose of delivery constitutes a PE under the UN model. This is also absent from the OECD model. Then business activities conducted by dependent agents without a fixed place of business in the source country for the delivery of goods or merchandise on behalf of the enterprise constitute a PE in the source country under the UN model. So these are source expanding provisions under Article 5 of the UN model that if African countries, for example, adopt these provisions, then they would eventually be able to expand their taxing rights over the income of non-residents. Then in Article 7, the UN model introduces a limited force of attraction rule. So basically, business profits attributable to not only the permanent establishment, but also from sales in that country, in that source country, or merchandise of the same or similar kind as those sold through that permanent establishment, or even other business activities that are of similar kind as those effected through the permanent establishment are taxable, based on the provision of Article 7.1 of the UN model. This is absent from the OECD model. And then Article 7.3 of the UN model explicitly lists allowable deductions in the determination of the profit of a permanent establishment. So it lists those allowable expenses as expenses which are incurred for the purposes of the business of the permanent establishment. The OECD model does not have this provision. Then in Article 8, the UN model allows source taxation of profits of an enterprise of a contracting state, that's a residence country, from shipping activities in international traffic in that state if such activities are more than casual. The OECD model only allows the residence country to tax such profits from shipping activities or operation of aircraft. So this is another example of a source expanding provision based on the provisions of the UN model. And then in Article 10, the UN model leaves the withholding tax rates for dividends paid by a company resident in a source country to a resident of the other contracting state to bilateral negotiations. The OECD model sets the limit to 5% of the gross dividends. So I believe that allowing this rate to be fixed by countries, because the UN model does not set the withholding tax rate. It basically leaves the withholding tax rate to countries to decide upon during bilateral negotiations. But the OECD model fixed the limit. So that means if African countries decide to use the OECD model or agree to the provisions under the OECD model, then they would restrict their taxing rights over dividends. The same under Article 11 of the UN model. The UN model also leaves the withholding tax rate for parties to agree to during bilateral negotiations. But the OECD model fixed the rate as 10% of the gross amount. So that means source countries cannot go beyond the fixed percentage, and this sort of restricts their taxing rights. Then Article 12 of the UN model also allows greater taxing rights for source countries. The first example is that royalties arising in a source country, whether through a permanent establishment or otherwise, is taxable in the source country. Under the OECD model, royalties arising in source countries and beneficially owned by a resident of the residence country can only be taxed in the residence country, unless if the royalties arise through a permanent establishment situated in the source country. And then Article 12 of the UN model also introduces an expansive definition of the term royalties. So there is an expansive definition of the term royalties in the UN model to include the use of or the right to use industrial, commercial, or scientific equipment or for information concerning industrial, commercial, or scientific experience. So basically, the addition of this definition kind of broadens the scope of source taxation of royalties arising in a source country. And then a key provision is the inclusion of Article 12A in the UN model, which allows source taxation of fees for technical services arising in a source country. And this provision is absent in the OECD model. So Article 13 of the UN model, that's another source expanding provision. It allows source taxation of gains, capital gains from the alienation of movable property pertaining to a fixed base available to a resident of a contracting state for the purpose of performing independent personnel services. And also source taxation of capital gains from the alienation of shares of a company or comparable interests. If the alienator at any time during the 365 days held a so percentage of the capital of that company or entity. So this is another provision that expands source taxation of capital gains based on the UN model. So taxation of other articles that are not covered in the UN model. So this Article 21 provides that other income not dealt with in the articles of the conventions can be taxed in the source country if such income arises through a permanent establishment or independent services from a fixed base, and the right of property in respect of which income is paid is effectively connected with such permanent establishments. So this is another example of a source expanding provision. It's very good to highlight this source expanding provision, but one thing to note is that there's been research done that shows that the OECD model is still the dominant model that is being used for tax treaty negotiations. So there's this 2014 study that reviewed about 1,800 tax treaties. And they found that the adoption rates for 21 of 30 UN provisions was actually lower than 40%. And for 12 of the UN provisions, the rate was 20%. So we see that the the OECD model is still the dominant model that is being used during tax treaty negotiations. However, some developed countries actually give some concessions to developing countries during tax treaty negotiations. So in the case of Canada, so there are actually a lot of source expanding provisions found in the tax treaties that Canada signed with some developing countries and African countries specifically. My professor, Professor Kim Brooks, she analyzed Canada's position in this regard. And she found that Canada has actually agreed to the extension of the concept of permanent establishment in, for example, 3 tax treaties with African countries: Nigeria, Senegal, Algeria, and Zimbabwe. So the extended definition of what constitutes a permanent establishment under the UN model, Canada actually has agreed to this extension in the tax treaties that is signed with Nigeria, Senegal, Algeria, and Zimbabwe. Then the limited force of attraction rule in Article 7 of the UN model is contained in Canada's tax treaties with 3 African countries: Tanzania, Nigeria, and Zimbabwe. And then the Article 7.3 of the UN model, which denies deductions other than expenses incurred for the purposes of the business of the permanent establishment, is present in Canada's tax treaties with 2 African countries. So we see that there are a lot of variations in the standards that Canada has agreed to in tax treaties. So very quickly, I move to some key findings from the analysis of the provisions of the tax treaties that Nigeria has signed. So Nigeria has 13 tax treaties that are in operation, and this is based on the tax treaties that the FIRS, that's the Federal Inland Revenue Service, put on their website. So Nigeria has tax treaties with Canada, the United Kingdom, France, the Netherlands, Belgium, Romania, Singapore, the Philippines, Czech Republic, South Africa, Pakistan, China, and Italy. However, Nigeria's tax treaty with Italy only covers air and shipping operations only. So as a capital importing country, it's actually very important for Nigeria to have expansive taxing rights over the income derived from economic activities carried out by non-residents in the country. So this is my argument. So Article 5, my analysis reveals that for Article 5, the PE provision, okay, so I said here that the PE provision is a very important provision in Nigeria's tax treaties. Yes, that's true, because it creates the nexus for taxing the income, business income of non-residents. So for this provision, I found that the time threshold for a building site or construction or assembly project or supervisory activities is 3 months in all the tax treaties. Except in the tax treaties with Singapore, South Africa, and China, where it is 6 months. So I noted earlier that the time threshold under the OECD model is 12 months. Under the UN model, it's 6 months. So it's actually it's a good thing to see that Nigeria actually has, a lower threshold even than the UN model, three months in most of its tax treaties, except with the tax treaty with Singapore, South Africa, and China. Then supervisory activities constitute a PE in all the tax treaties. This is good. This is also a source expanding provision, and it's contained in the UN model. Then the use of facilities solely for the purpose of delivery does not constitute a PE in any of the tax treaties. So I'm not sure why we missed this opportunity, because this is a source expanding provision and it's contained in the UN model, but unfortunately, it's not in any of the tax treaties that Nigeria signed. So a major thing I would like to talk about tonight is that the provision of services only constitute a PE in only 4 of Nigeria's tax treaties, and that's the tax treaty with Netherlands, Romania, Singapore, and South Africa. This is something that I think Nigerian government should go over and re-examine, because services actually constitute a very high percentage. I think it's about 41% of Nigeria's GDP. And so it's a major source of revenue. And so I believe that it should be adequately taxed because it's a key factor, it's a key contributing factor to Nigeria's GDP. Then under Article 5, I found that the anti-fragmentation rule, based on the provision of paragraph 4.1 of Article 5 of the UN model, OECD and UN model, is actually absent in all of Nigeria's tax treaties. And this is a provision that actually seeks to prevent the avoidance of permanent establishments through splitting of contracts by non-residents. Is absent in Nigeria's tax treaties. Then paragraph 6 of Article 5 is another major provision in the UN model. It seeks to create a nexus between an insurance enterprise that acts in a source state through a dependent agent. This provision is also absent in Nigeria's tax treaties. Yes, I would like to also talk very briefly about the taxation of the digital economy and how Nigeria has intervened in this regard. To solve the problems created by the digital economy, because there is a huge gap in the tax treaties about taxation of the digital economy. So the permanent establishment principle actually emphasizes the presence of a fixed base in the source country. And so we know that some of these digital services can actually be performed without a fixed base in the source country. So this is a huge gap. And so in 2019, Nigeria introduced the Significance Economic Test in its Finance Act to broaden the nexus required to tax the income of non-residents that operate on a digital platform. And there is a definition of significance economic presence. And this test applies to digital services, including streaming or download services, data transmission, goods and services, intermediary services. But one challenge is the fact that, this is some sort of conflict, because the tax treaties has this restrictive provision over digital services. And now we have a national legislation that has this expansive provision covering taxation of digital services. So I think it would be good to kind of revisit the tax treaties, to reform them to include this intervention, so that there is prevention of conflicts that may arise in that regard, because we know that under international law, tax treaty prevails. Where there is a tax treaty in existence, then Nigeria would be required to honor the provisions of those tax treaties. And so the solution would be that Nigeria should reform its tax treaties to include taxation of digital economy. Then Article 7, my analysis reveals that the limited force of attraction rule present in the UN model is actually absent in Nigeria's tax treaties with the United Kingdom, France, the Netherlands, Singapore, and China. It's present in Nigeria's tax treaty with South Africa, but Nigeria must show that such sales activities were structured in a manner intended to avoid taxation in Nigeria. And then allowable deductions in all the tax treaties, reflects the provisions of the UN model, which is a good thing. Then for Article 8, Nigeria is not allowed to tax earnings from the operation of ships and aircraft in the tax treaties with the United Kingdom, Czech Republic, the Netherlands, and China. For the other tax treaties, Nigeria is allowed to tax, but not more than 1% of such earnings, except for tax treaty with the Philippines, where it is 1.5%. Then for Articles 10 to 12, I found that the withholding tax rates actually for dividends, interest, and royalties vary among countries. So the rate is 12.5% for dividends in all the tax treaties, but for the tax treaty with Singapore, South Africa, and China, it's 7.5%. This is very low in my view. It's even lower than the prescribed rates no, it's actually higher than the prescribed rate under the OECD model, but the UN model leaves this open to bilateral negotiations. But I think 7% is quite low. Then for interest, the rate is also in most of the tax treaties is actually 12.5%. But for China, it's also 7.5%. Same with Singapore and South Africa. The Philippines is 15%. Which is high in my view. Then for royalties, the rate in most tax treaties is also 12.5%, except for tax treaties with Czech Republic, Pakistan, where it's 15%, and Philippines, you see 12%. This is a huge jump. I think this is good, this is high. Then Singapore, South Africa, and China is also 7.5%. None of the tax treaties actually has provision for taxation of earnings from technical services. This is a new provision that was included in the UN model. I think that's why, but I think with the reform of tax treaties, this can be included. For Article 13, all the tax treaties allow for the taxation of capital gains from the sale or alienation of movable and immovable property. I will just jump, because of my time, I'll just jump very quickly to my general remarks. Yeah, so I said here that Nigeria is regarded as the third host economy for FDI in Africa, with the main investing countries being the US, China, United Kingdom, the Netherlands, and France. And from my analysis, I can see that the effects of such restricting provisions on Nigeria's taxing rights is most pronounced in the tax treaty with China, where the withholding tax rate for passive income is 7.5%, the lowest. Then there is a longer threshold for these activities, 6 months. And then there is no limited force of attraction rule based on the provision of the UN model. Also, profits from the operation of ships or aircraft is non-taxable, based on the provisions of the tax treaty with China. Also, the tax treaties with Netherlands, United Kingdom also have great effect on Nigeria's taxing rights. Limited force of attraction rule is absent in both tax treaties, and then profits from the operation of ships and aircraft is not taxable in Nigeria. Then the tax treaty with the UK also disallows such taxation of gains from the alienation of shares deriving their value from immovable property situated in Nigeria. So my general remarks, I think there is a need for a concrete tax policy that adequately protects Nigeria's taxing rights. And I should note that while the provisions of the UN model are a good place to start to begin a tax treaty reform, they should not be the endpoint. So why I say this is because there are fundamental issues, like I noted earlier on with the UN model. You know, the arm's length principle, for example, tax authorities in African countries find it very difficult to apply the arm's length principle. So I think that there are fundamental issues that should be, you know, revisited by African countries in crafting better international tax rules. I'm not sure if I have enough time, Alison. Do you think? Okay, I should. Okay. So I'll just jump very quickly to the OECD's dominance in establishing international tax rules. So the OECD plays a dominant role in developing international tax rules since the collapse of the League of Nations in 1946. And they work through the subsidiary bodies to adjust international tax rules. So the 2013 BEPS projects is the OECD's current work on this subject. Well, the fundamental problem with the OECD BEPS projects is that it ignores the disparities between developed and developing countries. And there is an assumption that developed and developing countries have the same BEPS issues and they have the same capacity to solve these challenges. So at the start of the BEPS project, the OECD actually made it very clear that, you know, it had no intention to change the rules governing the allocation of taxing rights on cross-border income in tax treaties. Also, issues surrounding the application of the arm's length principle that African countries and developing countries in general are faced with, you know, was not mentioned. And so I think these are fundamental issues that really affect the outcome, the implications for African countries. So the OECD BEPS projects and the BEPS inclusive framework. So the OECD proposed a multilateral approach to tackle profit shifting through its inclusive framework. So it invited non-OECD members to participate in the implementation of the BEPS 4 minimum standards, even though they were actually not, their views were not taken into consideration at the beginning of the project. So I said here that the BEPS project was not designed to solve the problem of BEPS the way it is being experienced in developing countries. For example, the country by country reporting rules, which are designed to solve the problem of lack of adequate information about the global activities of multinational corporations, will not be accessible to countries that are not signatories to the OECD's exchange mechanism. As a matter of fact, being a signatory to this exchange of information does norming automatic access to tax information. Tax authorities in African countries actually report that they are being faced with a lot of challenges prevented from accessing some of this information. There are a lot of conditions that are being stipulated before they can have access. So it's actually not automatic as it seems. So the UN Subcommittee on BEPS was created for developing countries to gather the views of developing countries on BEPS issues that were of interest to them, and to feed this into the UN Committee of Experts work and the OECD's work on BEPS. So developing countries actually highlighted some of the challenges that they face. And those challenges include application with the arm's length principle, lack of information about the foreign operations of multinational corporations, lack of resources and qualified personnel in its national tax administration. So we see a lot of capacity issues, limited taxing rights over the passive income, so withholding tax rate, limited withholding tax rates in their tax treaties. So these are issues that are very important to developing countries, but what we see is that the issues were not addressed by the OECD. And so there's a lesson there for African countries, and the lesson is that they need to do a cost-benefit analysis of their role in the OECD BEPS projects and crafts better rules that suit their realities towards the fulfillment of the Sustainable Development Goals. Very briefly, I'll just talk about the implications of the OECD BEPS project for African countries. So I asked two fundamental questions in my paper. So the first one is that given the agenda setting and the formulation of the action plans in respect of BEPS issues was by OECD countries, do African countries possess the capacity to effectively influence the BEPS measures to fit their preferences and economic realities? And the second question is, if the answer to the first question is in the negative, then what are the consequences of not joining the BEPS predetermined agenda for African countries? So the answer to the first question is that they do not possess the capacity to effectively influence the BEPS measures. As a matter of fact, the BEPS agenda was designed without taking into consideration the realities of African countries. And so they have no influence over the BEPS agenda. And then, so what are the consequences of not joining? I think the major consequence is actually the fear of blacklisting. And I talked about that a bit in my paper. In 2017, Namibia was actually blacklisted for not joining the OECD BEPS framework, inclusive framework. And tax and non-tax measures were actually imposed, sanctions were actually imposed against Namibia. And that forced Namibia to join in 2019. So that's the fear of being blacklisted by OECD countries. Okay, so there are issues for African countries. There are implications of the OECD BEPS project for them. So the first one I talk about in my paper is a lack of consideration of specific BEPS issues that affect African countries. So there are fundamental issues that African countries have highlighted. The first implication is that OECD BEPS does not address these issues. And I believe that these are fundamental problems and African countries are in the best place to craft solutions that will suit their realities, not depend on the BEPS project. So there are also legitimacy concerns that the OECD country is made up of mostly developed countries, and so they're not the best institution to represent the interest of developing countries and African countries in this regard. So is the UN a better option? I don't think so. I don't think so. The history of the UN, shows that the UN actually lacks the capacity, the resources to drive fundamental changes to international taxation rules, and that's why I'm kind of arguing for some sort of regional analysis and regional solutions to international tax rules. Then capacity concerns. So I noted that briefly earlier about some of the challenges that impede the ability of African countries to actually benefit from some of these BEPS measures. And they include the cost of attending meetings, the peer review process, then the changes that are required to domestic legislation and tax treaties. So all of these are very big issues that affect African countries from benefiting from the BEPS measures. And then even if they have the capacity to implement some of these things, what's the end goal, right? So the issue is not just implementing, it's not just being able to implement the rules. The issue is the benefits that they would derive from joining the BEPS train. So in conclusion, taxation on multinational corporations is important to increase corporate income tax revenues in African countries. It's a significant source of revenue for African countries, so it's key. So, but gaps in international tax rules inhibits increased revenues from effective taxation. So hence the need for African countries to actually do an analysis of where they're coming from and where they are now, and sort of craft solutions that suit their realities. So the OECD BEPS project seeks to close gaps in international tax rules, but the failure in the OECD BEPS projects is the fact that African countries were not included in the agenda setting process, okay, so the peculiar challenges that the African countries face were also not taken into consideration in the BEPS outputs. So I said here that African countries should step up to the challenge and start to prioritize their interests and produce rules that are in tune with their realities. And the appropriate place to begin, I believe, is when each African country sort of evaluates their tax treaty network and analyze the need for tax treaties based on their peculiar situation. And then afterwards, I believe that a model tax treaty agreements can be created if necessary based on the aggregate analysis done by individual African countries. Thank you for listening.